Good evening once again. I want us to start on, we left on accrued, accruals and prepayment. I want us to basically start on accrued, and we say prepaid, what's called the prepaid expenses. Accrued and prepaid expenses. And we can spend a little bit of time on this, as short time as possible. So I want us to start on what we call accrued. Accrued stock outstanding, what we call outstanding expenses. Then we start with the sole trader. Accrued stock outstanding expenses. So what do you mean by accrued expenses? And how do we treat accrued stock outstanding expenses? Accrued stock outstanding expenses is one and the same. What do you mean by accrued expenses, Jenny? When you say accrued expenses,
these are expenses incurred but not paid for.
Yes, expenses already incurred but not yet paid altogether. PPE schedule, just all the PPE schedule. That is the last things that we do after doing what we want to do. The sole trader, partnership, manufacturing and limited company, and the cash flow will come and finish on those PPE schedule. So don't worry about it. Just have that, have the format, hold it there. So accrued expenses are expenses already incurred. Expenses already incurred, but not yet paid. Paid. Expenses that are already incurred but are not yet paid. How do we treat them in the income statement, and how do we treat them in the statement of financial position or the balance sheet? That is the main thing. So when preparing income statement, when preparing income statement, we say they are added to expenses. They are added to expenses already paid. So in the income statement, we basically add them to expenses that are already paid. So if you had accrued expenses, you add it to the expenses already paid. Then we need to understand that in the statement of financial position, in the statement of financial position, how do you treat them? Look at when you're doing the assets and liability. Accrued expenses, how do you treat them? They're treated as current liability. The statement of financial position, they are treated, we say they're treated as current liability. Basically treat them as current liability. Understood? We respond with a yes if you're there. So in the income statement or the P&L, we add them to expenses that are already paid. But in the statement of financial position, stroke the balance sheet, we treat them as a current liability together. Then we proceed to the next thing, that is the prepaid, what you call prepaid expenses. What do you mean by prepaid expenses? When you say prepaid expenses, what do you now mean by the prepaid expenses? These are adjustments to the final accounts. You can't do sole trader, neither can you do partnership and company without understanding these concepts. How do you treat, what is the prepaid expenses? Prepaid expenses?
Paid in advance.
Prepaid means paid in advance. In advance altogether. Yeah. So expenses paid in advance. We say expenses paid in advance. Expenses paid in advance. We basically say they are expenses paid in advance, i.e., that is to imply, i.e., they are expenses. They are expenses already paid. They are expenses already paid, but they relate to a foreign financial year. They relate to a foreign financial year. For example, you're paid for expenses for the year 2025 and you're in 2024. You paid for expenses for the year 2025 and yet we're in 2024. How do you treat them? In the income statement? In the income statement, we deduct, we say in the income statement, in the income statement, they are deducted from the total. We say they're deducted from the total of expenses. They're deducted from the totals of expenses already paid. They're deducted from the totals of the expenses that are already paid. So if you have a prepaid expenses, let's for example, you had rent, and on the rent is a prepaid expenses, maybe expenses for 2025, then you need to less them in the income statement. What about in the statement of financial position of the balance sheet? So we say in the statement of financial position, they are treated as a current asset. So in the statement of financial position or the balance sheet, we treat them as a current asset. Is that noted, Joseph? Is that noted, Shipper? Is that noted, Paris? And is that noted, Ronaldo Monti? Is that noted, Musa? So that is done on the accrued and prepaid expenses. Any question? And we have a marathon. We are meeting tomorrow, and on Monday we are meeting for 3 to 4 hours. On Monday we are meeting for 3 to 4 hours. So that is how we treat them. Together, team. Very fast we respond. Are we sorted? If we are sorted, we need to respond as fast as possible. Then I want us to go to prepaid, what we call the prepaid and accrued income. Prepaid and accrued income. Perfect. So I want us to start with accrued income. What is an accrued income? What is an accrued income? How to deal with accrued income? We know our incomes relating to current year, current period, but are not yet received. Incomes relating to the current period, but not yet received. Incomes relating to the current period, but not yet received. Incomes basically related to the current period, but not yet received. Are we together? So that the income of the current period, but they're not yet received. How would you treat them in the income statement, and how would you basically treat them in the statement of financial position? In the statement of financial position, that is accrued income. How would you go about them?
In the statement of financial position, you treat them as receivables.
In the statement of?
Balance sheet is treated as receivable.
As receivable. What about in the income statement? What about? How would you treat them? In the income statement.
We less them from the income.
What about prepayment? If you less them from the income statement, how would you now treat prepaid income? How would you now treat them? How would you now treat prepaid income? And remember, if you go back to when we were discussing accounting equation, that is assets is equals to capital plus liability. We mentioned a number of things. So remember, this is an income that is already earned, but money has not yet been received for it. So what is very important, we know that number one, what you call in the statement of the financial position, we treat it as a current asset, Are we together? In the statement of financial position, that is basically the balance sheet, we treat it as a current asset. Are we together? We treat it as a current asset, And in the income statement, we add it to the incomes already. We say that we add it to the incomes already received. We add it to the incomes that are basically already received. That is how we treat it altogether. So I've said in the income statement, we basically add it to the incomes that are already received. But in the statement of financial position or the balance sheet, we treat them as a current asset. Together, team. Are we together? If you're together, then we respond with a yes. Are we together? Are we together? If you're together, we respond.
Yes.
We don't deduct, but you add it to the income statement. Go to prepaid incomes. Now, is there somebody talking?
Yes, of course.
Yes, be audible.
Kindly, if I may ask.
Yes.
How do you differentiate between the debtors and the receivables?
Debtors are the same as receivable. So debtors, we call them accounts receivable. The other name of debtors, we call them accounts receivable. Debtors, we also call them accounts receivable. You remember when we were doing the assets, and you say that assets, one of the assets is the debtor, and we also call them accounts receivable. So sometimes in those questions papers, you'll always see, you say? There's noise on your end. There's a bit of noise on your end. There's some noise on your end.
David Ochala, kindly mute.
Kindly mute some noise.
Sawa. Na wasalimia.
Ochala, kindly mute.
So you can proceed. You can proceed. Proceed, whoever was communicating to proceed. There's a gentleman who was asking a question. Kindly proceed. Kindly proceed.
You had already attended to my question, so I thought maybe there's a difference between receivables and debtors.
You thought that it was?
I think.
You thought that?
I thought maybe they might.
No.
They might
we were talking about incomes. You see, we were talking about income. Yes. So you're not talking about an asset, but you're basically talking about incomes altogether. On this end, we were talking about prepaid, accrued and prepaid income. We were not talking about debtors, but we were talking about accrued and prepaid incomes. Together.
Okay.
Are we together? I think that's where you have a confusion. But we are talking about incomes.
Okay.
And basically, I was saying that accrued income These are incomes that are already earned, but money has not yet been received. And you're basically saying that if you have an income that is already earned, but income has not yet been received, in the income statement, we basically treat it, we add it to the incomes that are already received. But in the statement of financial position or the balance sheet, we treat it as a current asset. So then you proceed to what you call a prepaid incomes. So what do you mean by prepaid income? Prepaid income. Prepaid income. When you talk about prepaid income.
These are income received in advance.
So basically, when you talk about prepaid incomes, these are incomes that are already received, but we say goods or goods have not yet been received or services have not been rendered. For example, you go to a place and you're paid money, but you've not worked together. That is a prepaid income together. Are we together, Joseph and the team? Incomes that are already received, but no goods has been received or no service has been rendered. That is called a prepaid income. It is basically called a prepaid income. And the question is, how do we treat the prepaid income? Because some of the adjustments that we intend to do in the sole trader, these are adjustments to the final accounts altogether. Adjustments to the final accounts. Once we have the trial balance, we'll have entries that touches on outstanding and prepaid expense. How do you go about it? That is what we intend to solve with these adjustments to the final accounts. So how would you treat prepaid incomes? Prepaid incomes. In the income statement, what would you do to it? If you have an income statement, basically what you're going to do to it is that you're going to less it on the incomes that are already paid altogether. What about statement of financial position or the balance sheet? How are you going to treat it? How are you going to treat it? In the income statement, in the statement of financial position. We say that in the income statement, you less it on those incomes that have already been received. You will less it on that. So what about in the statement of financial position? How would you treat it? It will be a current liability because services are not yet. You still owe the person who pays you altogether. Not until you've done the work. The work is when you can claim it as your own money. So you say prepaid expenses, income are incomes that are already received and incomes that are already received, but goods have not yet been received, or services rendered, or services rendered, whichever. Then you say in the statement of financial position, in the statement of financial position, we treat it as a current, we say we treat it as a current liability. We treat it as a current liability. And you say in the income statement, we deduct it from the incomes, from the incomes already received. We deduct it from the incomes that are already received. Together, team. If you're together with that adjustment, we respond. If you have a query, then we also ask the question. Are we together? If you're together, then we respond with these. Tuko sawa?
Yes.
Perfect. So I want us to go to the adjustment that is bad in that debt. what you call bad and doubtful debt. What you
Excuse me,
call
sir.
bad and doubtful debt.
Excuse me, sir.
Yes, let me just write this down. Bad and doubtful debt. Back to you.
Yes, I thought the prepaid income, now that they're having an increasing effect
The
on
prepaid?
cash, we treat them like as a incomes. Now
Yes,
that they're
income.
having an increasing effect on
There's a scratch
cash,
at
we
least.
treat them as an
On your end, there's a scratch.
I'm saying now that prepaid income has an effect on increasing cash on our
Yes.
account, I thought we treat them like current assets.
No, it cannot be an asset. Why is it not an asset? Let's say, for example, in an event that you don't deliver the goods, what now happens? In an event that you don't deliver the goods, what now happens? Let's say, for example, you have received money, and that money was intended for you to deliver a consignment. What happens? Maybe you were told to deliver in 10 days and you failed to deliver. What now happens? Are you going to hold that income in your account? Are you basically going to hold that income in your accounts?
No.
Yeah, so that's why it's a liability altogether. That's why it is a liability. Let's say, for example, you worked in a particular place, and in that particular place altogether, you are paid in advance altogether. You are paid in advance. And let's say, for example, for a particular number of days, let's say maybe day 1, day 3, and day 5, you failed to show up and the money was already paid. On the following month, what normally happens is that you're going to be deducted. It means that you owe altogether. Now, if you didn't deliver on those particular days, what happens is that the organization will definitely hold you accountable, meaning that you owe that organization for a particular day, maybe day 1, day 3, and day 5. That's why we call it a liability. Together. Are we together? I hope that is explained. So I think that should be sorted on that. And I want us to proceed on what you mean by, we'll start with what you mean by bad debt. When you say bad debt, what do we basically mean by bad debt before we go to the accounting treatment of the bad debts? What do you basically mean by the bad debts? When you say bad debts,
I can try.
Yes.
I think bad debt, these are money owed to an organization or a person that were failed to be paid on the due dates.
Yes.
And now has to be.
Yeah. But basically the keyword is just when you talk about bad debts, these are debts that are irrecoverable. That these are debts that may not be recovered altogether. Bad debts, these are debts that are irrecoverable. So the keyword is that these are debts that one may not be able to recover. So we say are debts that are irrecoverable. These are debts that one may not be able to cover. Are we together? What will lead, for example, for a business for debts to be recoverable? What are reasons for bad debts? Reasons, when you say reasons for bad debts. Why would a business not be able to, for example, to recover debts that are basically incurred?
Bankruptcy.
And number one reason is when debtors decline to pay. When debtors decline to pay. One of the reasons is basically when debtors basically decline to pay. That is the first reason why a business may not be able to recover debts altogether. Again, what would be another reason? Debtors may become bankrupt. When debtors become bankrupt, when the debtors, we can talk about when the debtors become bankrupts. When debtors becomes bankrupt. So in those instances, what should happen to the books of accounts when debts are become irrecoverable? When you notice that the number of individuals who owe you, number of debtors, you gave goods to them, but you realize that they're not able to pay you. What should you do?
Write them off.
That is, you do what?
You provide for a write-off.
We write them off. And basically, as we write them off, we treat them as an expense altogether. When you get to the format of the income statement on the notes that I gave, you see one of the expense is bad debts altogether. So we say that when they become irrecoverable, we say they should be, we say written, they should be written off and treated as an expense altogether. We should basically write them off and treat them as an expense altogether. We should write them off and treat them as an expense. We should write them off and treat them as an expense altogether. So accounting treatment. Now the accounting treatment, what you call double entry accounting treatment of the bad debt. How would you treat the bad debt, the double entries for the bad debt? Because it's an expense, how would you treat it? How would you treat it? The bad debts.
We debit the bad debt.
We debit?
The bad debts.
We debit the bad debts. What you call the bad debts? Bad debts written off. Accounts. Then what do we credit? What do we credit?
Profit and loss account.
You credit? What? Where do we reduce? The debtor stock receivable accounts altogether. We have what you call the debtor stock, what you call receivable accounts altogether. So debtors are also the same as accounts receivable. That is accounting treatment of bad debts altogether. Then we have the next thing, what you basically now call the provision stock allowance.
I have a question.
Are we together at that point? If you're together?
I have a question.
Yes.
Bad debt, how long is there a standard period that someone should consider bad debt? For example, you're following up with a customer and they keep saying, I'll pay, and then after how long, or is it like dependent on each company when they want to
on the policy
consider
of the
that
company. It depends on the policy of the company.
Okay.
Yeah. You didn't say that this organization, when it takes like 4 years, it should be written off. So it depends on the policy of the company. Are we together? But now this is, on this end, we say that how do you treat it? We treat it as we write it off and treat it as an expense together. So the impact of that is that basically, as when you write it off, it basically reduces what? The debtors altogether. If we had a debtor of, let's say, $1 million, and we realize that out of $1 million, 100,000 of the 100,000 are bad debts, and we've written them off, basically we're going to reduce the debtor to 900,000. So then we proceed to what you call provision. What you call provision, stock allowances for bad and doubtful debt. Allowances for bad and doubtful debt. Allowances for bad and doubtful debt. So when you talk about provision, when you talk about provisions to allowance for bad and doubtful debt, when you talk about provisions, what do we mean when you talk about provision? when you talk about provision for bad and doubtful debt. We have done the deposition as one of the adjustments to the final accounts. We've done prepayment and accrual, both on the expense and the income, and we're now on bad and doubtful debt. So what is a provision?
Oh, if I might try,
Yes.
this is a percentage or rather amount of cash that is set aside on debtors that maybe a company might feel like they might not be in a position to pay it on time.
Definitely, just is an estimation. You know, when you talk about provision, we make an estimation. We can make a provision, for example, that out of the debtors that you have, maybe 10% are likely not to pay, altogether. So that is basically doubtful debt are debts that are expected doubtful debt. We say that doubtful debt are debts expected not to be paid, expected by a debtor, stock a customer. So, for example, if you had debtors of maybe 100,000, you can maybe make a provision and say, out of maybe 10,000, you say 10,000. Out of 10,000, 2,000 are likely not to pay together. That is a provision. That there's a likelihood that out of the debtors that we have, if it was 10,000, then there's a likelihood of 2,000 not paying. Are we together? So again, that implies that is basically expected loss altogether. That is an expected loss. If, for example, you say that 20% of the debtors are likely not to pay, that is what you call an expected loss. Are we together? To be taken into account. An expected loss. So we basically say expected loss. We basically say this is expected loss. This is expected, what's called expected loss, taken into account, unexpected loss taken into account in the current financial year. In the current financial year. In the financial year. If you look at, for example, the TB, the trial balance, you'll only see whoever has tackled those TB, you'll only see a provision that has been made altogether. Do you only see provision for bad debt or allowance for bad and doubtful debt? So a company can make a provision altogether and maybe say that out of this is the provision for the year, 10,000 are likely not to pay altogether. So we say expected loss to be accounted in the current financial year. For the purpose of provision, doubtful, for the purpose of provision, doubtful debt are accounted for as follows. So for the purpose of provision for doubtful debt, we account for it as follows. Let's say, for example, you made a provision that 2,000 are not debtors. We just say 2,000 shillings. This is the provision in the TB. Then at the end of the year, this is the provision that was made. And then at the end of the year, the actual amount of bad and doubtful debt, we just say actual amount, is basically 2,500. What happens in this scenario? If the provision that was provided in the TB was 2,000 and the actual amount is basically 2,500, what happens? What is that? What happens in that
increase
scenario?
in provision.
So we have a
There is
provision
an
that
increase in
2,000
provision.
is not likely to be paid. But at the end of the year, the actual burden doubtful debt is 2,500. So what happens in that scenario? In that scenario, what happens? And then we have scenario 2.
There is an increase in provision.
Scenario 2, we have 2,000 as the provision that was made on the TV. Provision. Then the actual at the end, we have a figure of 1,500. Those two scenarios that we have. What basically happens in those two scenarios? The first scenario, are we there? Are we there on the first scenario? We'll look up. Are we there on the first scenario? So the first scenario, a provision was made for 2,000, and the actual amount of burden doubtful debt is 2,500. So we have an increase. This is an increase in provision altogether. Increase in provision, we call it increase in provision. Provision for bad and doubtful debt. And doubtful debt. Then the second scenario, if we made a provision of 2,000, then the actual bad and doubtful debt is a figure of 1,500 altogether. So what happens again if that provision, there's a reduction, we call it a reduction. This is called a reduction. What's called a reduction in the provision. For bad and doubtful debt. For bad and doubtful debt. Are we able to first of all to depict what I'm saying on that? Are we able to depict what I've said? Jane, David, Musa, Marcy, Paris, Ronald, and Shiba. Are we able to get what I'm saying?
Yes.
Perfect. So in both scenarios together, scenario 1 where the provision that was made was 2,000, but the actual amount at the end of the year we find to be burden doubtful debt to be 2,500, implying that we have an increase in provision altogether. So we say that increase in the provision for burden doubtful debt is basically treated as an expense. So increase in burden doubtful debt is treated as an expense altogether. So when there's an increase in the provision, we basically treat it as an expense. And then we say that when there's a reduction in bad and doubtful debt, we basically treat it as an income. So reduction is basically an income. An increase in bad and doubtful debt is an expense. Is an expense together. So for the purpose of provision, we account for as follows. So we can have the first scenario. Scenario 1. We say once allowance for doubtful debt has been created. We say has been created. So once you create that account, we have it. We know that we have the first scenario. We have the first scenario. Once we create it, basically we're going to do what? We are going to debit income when you're opening that account. When your income statement, we're going to debit income statement. That is expense. And then we credit allowance for doubtful debt. That is why when you have it on the TV, you have it on the credit side. Allowance for doubtful, for bad and doubtful, for bad and doubtful debt. So we present the two scenarios, one that account has been credited. So we have the first, we call it A. I hope you're able to see that. With increase, we say with increase in bad and doubtful debt, with increase in bad and doubtful debt. What did you say when you have an increase in bad and doubtful debt? What did you say we do? With an increase in bad and doubtful debt, what did you say? Somebody just remember. With an increase in bad and doubtful debt, what do we
treat
do?
them like as expenses.
We treat them as expense. So what are we going to debit if it's an expense? What do we debit? What do we credit if it's an expense? These are very important for us. Very, very important for us. What do we do?
Allowance for doubtful debts.
We do what? We debit income statement. Because it's an expense, we debit income statement because it's an expense. And then we do what? We credit allowance for bad doubtful debt. We credit allowance for bad and doubtful debt. We credit allowance for bad and doubtful debt. Together, team. So scenario 2, we call it with decrease in bad and doubtful debt. With decrease in bad and doubtful debt. This is an income. When that is an income, what happens? We know that this is an income. What do we debit now? And what do we credit? What do we debit and what do we credit? So the reverse. If that is an income, we do what? We debit now allowance, what you call allowance for bad and doubtful debt, and then we credit what? Income statement. We credit the income statement because this is an income. We credit on the income statement or on that TP, you find that should be credited. We credit the income statement income. That means that this is an income. And you'll add it, decrease in doubtful, bad and doubtful debt, that you add it to other incomes. Are we together? Are we sorted? If you're sorted?
Not yet. A moment, please. I still don't understand. Allowance for bad debts.
Yes.
Which ledger is it going? Okay. The way you've said the income statement expense, that one I understand it's going to the
Yes.
income statement. This allowance for bad and doubtful debt, where is it going? Is it a liability?
No, it's an account. You see, it's an account, for example.
Yes.
That account is basically to help us whether we have an increase or decrease in the provision altogether. So normally, if you have a TP, trial balance, you'll see allowance. If you have a debit and credit, you see allowance. It's like a allowance for bad and doubtful debt, and the figure is on the credit side. Sawa. Tuko pamoja. Jen, ni nani?
It's me. No, but it's fine.
Yeah. No, repeat it again. You don't say no and you're fine. All right, together. The essence of creating this account, you see this account where we have income
So this
statement.
account doesn't. So this
You say?
account doesn't go into the. I'm saying so this account doesn't go into the income statement or balance sheet.
It
It's the
doesn't.
difference that we get. It doesn't. Oh, okay.
It
So
doesn't
it's the
go.
difference that we get that will determine whether it's going to be an income or an expense.
Definitely. So the essence of
Okay.
creating this account is to determine whether the provision is going to increase or decrease altogether. Sawa.
Yes.
Perfect. So I want us to go to sole trader. I want us to start on sole trader. But I want you to open the formats that I gave you. See on the notes. Sole proprietorship. I want us to open the sole proprietorship. On those notes. and we have the format. We just have a simple format. Then we make a question. So when you talk about sole proprietor, have you opened the format? Have you opened the format? So we can say sole proprietor is a form of business organization. We know that is a form of business organization, but not a common question for you. Owned and operated. We say owned and operated by one person. We say owned and operated by one person. That is sole proprietorship together. That is a sole proprietorship. One person who makes one person, operated by one person, who makes all operating decisions, who makes all operating decisions, and this person basically make all operating decisions, and the entire profit, and enjoy, just say enjoy the entire profit, but also we know also suffer all the losses, but also suffer all the losses together team. But at the same time, this person suffers all the losses. So out of that point, we can clearly depict that under sole proprietorship, one of the advantages that one person is technically enjoying on the profit. Again, decisions are also able to be made very fast because there's one person at the helm of decision making. As opposed to where we have company where we have a number of shareholders, decision making will take long. But for this sole proprietorship, we know for sure that one thing that is going to happen under sole proprietorship is that decisions are made quite faster together. When it comes to decision making, decisions are made very faster because there's only one person at the helm of making decisions. But at the same time, we know that some of the things that we can really depict on the sole proprietorship is that this person is able to enjoy the entire profit alone, which is a good thing. Is it a good thing, Jane, that one person is able to enjoy the profit alone?
Yes.
This one person is able to enjoy the profits alone. Are we together? But again, also the risk in it together. This person also suffer all the losses alone together. So we need to understand, again, very important, that sole trader is not a legal entity, is not a separate legal entity, is not a separate sole proprietorship is not, you say is not a legal entity. That is to imply some of the questions that you can find in a TDN comes one. Which form of a business is a legal entity? We remember that a company, under company will say that the company is a legal entity, meaning that the company and owners of companies are separate. Those are separate entity altogether. But for a sole proprietorship, we know that this is basically a sole proprietor cannot be separate, the one and the same altogether. So what are basically being prepared altogether? Sole proprietorship, the following final accounts. We have final accounts, what you call final accounts, prepared. Final accounts prepared under sole proprietorship. Very important because those are the questions that are likely to come. So one, we call it income statement. Income statement, we have one of it that we prepare. Income statement, or what you call the statement of profit and loss, or what you call the statement of performance, or the statement of performance. Are we together? Or the statement of performance. Tuko pamoja? I hope you're flowing. And a statement of performance. And the next we have what we call the statement of financial position. Number two, that is normally we call it the statement of the financial position. The statement of the financial position. Tumeelewana hapa. Are we sorted? Tuko pamoja. We respond if you're together. If we are together, I need us to respond.
Yes.
Perfect if you're together. So perfect. So I want us to proceed to the first format. I know you have the formats. Do you have the formats? You don't need to copy the formats. I'll just explain the formats because you have the formats in your notes. So we can start with the income statement. Income statement. So we can say XYZ enterprise. XYZ enterprise. And we call it income statement. And we say as at we can say 31st, 12, and 2023. So we have this and this, just a brief one together. We can say sales, we start with the sales. Can you see this in the format in the notes altogether? I hope I can make a brief one, then we say less sales return, what you call sales return, which is the same as return. It's called return inwards. You less sales return. So when you less that, we get what you call net sales. You get the net sales. You have the figure for the net sales. Then you go to what you call cost of sales. We can have cost of sales. And in this case, cost of sales, we have what you call opening stock. We say opening stock. We have that figure. We add purchases, add the purchases. Tuko pamoja. We respond if you're together. Carriage inwards, we say add carriage inwards are like the transportation costs. Carriage inwards. We have with less return outwards. Return outwards. And the other name for return outwards, those are purchases return. Those are purchases basically return altogether. And then you can also less what you call drawing of goods. We have the drawing of goods. I hope you have the notes. So just on your side, you just look at the notes in the format altogether. You just look at the notes on the format. So when you less this gives us goods available for sale. We have the goods available for sale. When you have opening stock, you add the purchases. We have the carriage inwards. Return outwards is the same as purchase return. Less drawing of goods. We have goods available for sale. Then we less closing stock. So less closing stock, what you call the closing stock or closing inventory, closing stock. So the closing stock is that. Once we less this is the figure of the cost of goods sold. What is the difference between net sales and the gross and the cost of sales? Net sales and the cost of sales. So that is what we have. I hope you can see. We have the GP, what you call the gross profit. Gross profit, we have the figure. And I hope you are able to see that in the notes. That is the GP. We have the GP on that. So then you say add other incomes. We now proceed to add other incomes. And I'll start with one of the incomes that we have talked about. One of the incomes to ongelea. We can say decrease. We can have decrease in bad and doubtful debt. One of the reasons why we open that decrease in bad and doubtful debt. We have discount received, discount received, also additional, discount received, discount received, discount received, discount received. We can also talk about other rent received. We can also talk about commission or other income commissions received. So commission received, we have it. So when you add the GP that we had here, look up GP plus other incomes. Down here we get what we call total income. So we have the total incomes on that end. We have the total incomes on that end. Tuko pamoja. We have the total incomes on that end. Tuko pamoja, team? Tuko pamoja. I want us to respond if you're together. Are we together? Tusichukue muda to respond. We just say yes. If you're together, we just say yes. Yes. So after that, we go to less expenses. We say less expenses. Less expenses, less expenses. Expenses are numerous together. We can give a few. We have depreciation. So when you say depreciation of PPE, PPE imebeba building, imebeba furniture and fitting, depreciation, let's start. Then you have carriage outwards, we have that, carriage outwards. We can have bad debts written off, bad debt written off, bad debts written off. We can have increase, what we call increase in bad and doubtful debt. In bad and doubtful debt, increase in bad and doubtful debt. We can also have what we call discount allowed, discount allowed. So these are just but a few. So this gives you the total expenses. So what happens? So we can have a net profit or net loss. In this scenario, we can have a net profit, stock loss. So when you have a profit, what happens? When you have a profit team, when you have a profit, what happens? When you have a profit chain, what happens? When we have a profit, what happens?
You pay tax, 30%.
When you have a profit, what happens? What happens?
You pay tax.
It's a positive.
30% of the income.
We have a positive value. And when you have a loss, what happens? When you have a loss, what happens? When you have a loss is, it means expenses are more than. So this is a profit, meaning that incomes are more than expenses.
Excuse, kindly
Yes.
start from less closing stock.
Less closing stock. So when we
After you
closing
less
stock, uko na mimi hapa.
Yes,
Ni nani? Your name?
Christabel.
Okay. So when you less, these are goods available for sale. Then when you less closing stock, we get what you call, this is now the cost of sale. The total for the cost of sales. Tumeelewana? So net sales minus cost of sales, we get what? Gross profit.
It's okay. That's what I wanted to know because I can't see the other side of the board.
You're saying?
That is what I wanted to know because I can't see the other side, the furthest side of the board.
That is the gross profit. Are you able to see it? You are together with me now?
Yes, I've understood.
Perfect. So is there anybody who has a question before we go to the format? Now for the format now for maybe for 82 students. You can be given a questions 82. Now that's for 82. So how do you get cost of sales or cost of goods sold? Cost of sales stroke cost of goods sold. So cost of goods sold. So how do you get the cost of goods sold? We basically say that opening, these are not simply these questions can come. You're given a financial statement or maybe with spaces. You're told which space, what is this? How do we get this? That is now for HD2 and HD1. Do I have HD2 and HD1 in this class? HD2 and HD1. Do
Yes.
I have them?
Yes.
Don't be afraid. So another scenario,
Yes.
you're given cost of sales and you're given a missing figure. Maybe this is missing. How do we get it all together? So we know that the cost of sales is basically opening stock. We have the opening stock plus what you call purchase. You can say purchase plus carriage inward. Then you say minus purchase return minus the purchase return minus drawing of goods. We have minus drawing of goods. Then you have minus closing, what you call the closing stock. Minus the closing stock, minus the closing stock at that end. That is for HD1 and HD2. Those are questions that you can be asked. What is gross profit? What is the gross profit? So gross profit should be basically net sales, stock sales minus cost of sales. Net sales, stock sales minus cost of sales, minus the cost of sales, minus the cost of sales. Then you have, how do I get net profit? Let's simplify what you have. The net profit in this scenario, I will have it as a net profit stock loss. I will have what you call gross profit plus other income. Gross profit plus other incomes. When you say plus other incomes, then minus expenses, minus the expenses. Tuko sawa? Are you able to see that on in your notes? Then we have the last format. We can have our last format. Are we there? If we are there, you have them in our notes. Those formats do you have. So I want us to proceed now to the statement. We can say X, Y, Z, enterprise. We have the statement of financial position. Statement of financial position. Statement of the financial position. Are we there? The statement of financial position. Check the apple. Do you have them in the notes? If you have them in the notes, we respond.
Yes.
So we can have we say statement of financial position, we can say at call it the past 12 of 2023. So we start with the non-current asset. Non-current assets. We have that. So we have land. and building. Are you able to hear me? We respond with a yes if you're able. Or type a yes if you're able to hear me. And there's something I've written net value. Meaning the less it is yet, the less depreciation. So we can have them there. Now, plant and machinery. Machinery. And our fixtures for our fittings and fittings. We have motor vehicle. Coming down. We can have the totals. 2 motor. Kindly type a yes if we are together. Type a yes if you're together. Then we proceed to what we call current assets. Current assets. So current assets, we have stocks, closing stock. We call it closing stock. Closing stock. We have data, stock accounts, receivable. And we have cash at bank. We can have that figure. Cash at hand. We have that. Then we can talk about prepaid expenses. We can have prepaid expenses. Then we can have accrued income. So we have that. So at that point, down here we have total assets. We have the total assets. So that gives us total assets. Tuko sawa hapo? Kindly respond kama tuko sawa. Kindly respond kama tuko sawa.
Yes, tuko sawa.
Are we together? Kindly respond if you're together. Tafadhali, tafadhali, if you're together, we respond. If we are together, kindly respond. Kama tuko pamoja. Tim, I need you to respond. I need you to respond. We respond kindly.
Yes,
Tim, just type.
Yes, we are together.
I can't
We are
hear you
together.
training, so you can just type.
Yeah, okay.
You can just type. So then we say that assets are normally, we say financed by. Bookkeeping equation, remember, we say that assets is equal to capital plus liability. So we say financed by. We have capital. Capital. Then we can talk about net profit. Profit. Stock loss from P&L. So if it's a profit, we add. If it's a loss, we are going to less. Then we say less drawings. Less drawings. Less drawings. Then at this end, you have what's called net capital. We have the net capital down here. So then we go to what's called non-current. What's called the non-current liabilities. So the non-current liability, these are long-term loans. These are basically long-term loans. The non-current liability Those are essentially the long-term loans. Those are essentially the long-term loan. We can talk about loans. We have it there. Then we have the current liabilities. So current liability, we have creditors. We have accrued expenses. Then we have what we call prepaid income. You can have a prepaid income. So down there, we have total capital plus liabilities. Total capital plus liability. So this figure should balance with this figure. Assets is equal to capital plus liability. So this figure should balance with this figure. Tuko sawa? We respond with a yes kama tuko sawa. I want us to pick a question. I want us to pick a question. Tuko sawa? Are we together? I want us to type if you're there. Format. Who has a question? You can type on the format. Who has a question on the format? Who has a question on the format?
Yes,
Nani
does
ana
the
swali kwa
drawings,
format?
the drawings,
Who has a
is
question
it
on the
cash
format?
drawings or goods, both the goods and the cash drawings?
Class, you type. Who has a question on the format? It's raining heavily. It's raining heavily wherever I am. Who has a question on the format? I want us to pick on our first question, but I'm asking who has a question? Are we together? Drawing. What is wrong with drawing? Ronaldo Mondi? What is wrong with the drawing? No, drawing, for example, when you look at those books that were drawn, are we together? Drawing, if you draw goods or you take cash from the business, we call it drawing. Sawa. If we took goods from the business, if the owner took goods from the business, or he took cash from the business, we call it drawing. And in the statement of financial position or the balance sheet, we need to less in order to get what? The net capital. Sawa, Ronaldo Mondi. Ronaldo Mondi, are we together? Ronaldo Mondi, tuko sawa. Nani ana swali ingine before nipatiane swali? Before I get a question for all of us. Nani ana swali? Nani ana swali?
Kuna swali, tuendelee.
Nani ana swali? So as we take a small break, I want us, this question is a very good question. That is May 2019, question 5. 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 Tuko sawa. That is simply A. So get that as we take a break, you come back to that question. Tuko sawa. As we take a break, you come back with that question. As we take a break, you come back to that question. Tuko sawa. We respond as we take a small break. As we take the break, you come back with that question. Our representative, is that fine?
Yes, but please leave the whiteboard on.
Get what?
Leave the whiteboard on because I'm trying to.
So May 2019, question 5. Can I repeat the drawing? Let's say, for example, when the owner of the business took some goods for personal use, or he took some money for personal use on Monday, when the owner of the business took some goods or took some cash for personal use, we call it drawing. How do we adjust drawing? Drawing does not, drawing of cash does not affect the P&L. It's only the drawing of goods that affect P&L, but drawing of cash does not affect the P&L. After deducting even the drawing of goods from the P&L, you need also to come to the statement of financial position and less it on the capital. Remember that reduces the capital. When a owner of the business took goods for personal use or took cash for personal use, that should less the capital of the owner of the business. Are we together, Monday? For Monday, perfect, if that is, we are together. Somebody to share that question, May 2019, question 5. May 2019, question 5. May 2019, question 5. Tuko sawa? May 2019, question 5. Is that okay? Jane, can you send that question to the class? Can you send that question so that when you come back?
Yes, yes.
Can you send it, Jane?
Yes, I'll send it.
Yes, send it. We can have our break, then we come back. 10 minutes break, then we come back. I hope we have that stamina. We have the questions. Do we have the question? And are we in? If you're in, we respond with a yes. Can we bake on that? A very good question. This is a very good question. It has ledgers on it. It has ledgers on it and a number of things. Can we start? We respond with yes. Can we start with it? Are we in? We respond with a yes if you're in. Are we there? If you're there, we respond with a yes. Are we there? Class, are we there? We can read the start of the question. We respond if you're there. Kindly. We respond if we are there.
Yes, we are there.
So perfect, we can start on that. So we've been told that Moses Rono sets up a restaurant business on 1st April 2018. So on 1st April, Rono opened a business bank account. On 1st April, Rono opened a business bank account of his own personal saving. Into the account. So we open this ledger so we can have our working. We say that working. We call it working one. So we don't have capital. This question hakuna TP. So then we have to work out. So I open a capital account. So open a business bank account and deposit 500,000 from his own personal saving. So then we have bank account. So it means that on 1st April, we have it 1/4/18. Call it capital. So capital is a figure of 500,000. Capital is 500,000. So we debit that together. So we debit that in the bank. And then we credit the capital account with the bank. That is 1,4 of 18. That should be bank, return to the bank. That should be 500,000. The past ledger. Tuko sawa? Watu wangu tuko sawa? Tuko sawa? We respond
Yes.
kindly with the yes. We're here together. So at Accrued TV, there's no trial balance. We need to open these accounts. We know how much capital. We need to know balances at the end of the year in the bank. We need to understand cash, how much cash is available. Together, team.
Yes.
Tafadhali Jen na watu wangu wote, we concentrate. Are you tired? Guys look tired. Then you're being told that you also introduced the business cash amounting. You also introduced business cash. You also introduced a business cash. You also introduced a business cash. You also introduced a business cash of 70,000. So if you open a cash account, we have a cash account. So cash account was this from this person. So we have a capital 1,418. So we have it goes into cash. That is 70,000. Then on cash account we debit 1,4 of 18. That should be capital. That is 70,000. Tunaelewana hapo? Are we together? Tunaelewana hapo. Then equipment worth 150 from his house. So that is also capital, but then we open equipment. So this equipment is basically we have 1,4 of 18. We have equipment. That is 150. So on equipment we debit, we know that was a form of capital. 18, we have capital. That is a figure of 150. A figure 150. Up to that point, none as well. Open this on these ledgers. This person did not have money, and therefore he sorted. This money was introduced by the owner. Number one, he introduced cash into 500 into account. He also brought cash into 70,000 into cash account. At the same time, he brought his own personal equipment into the business. That's why we opened that. Tuko pamoja. Together.
Yes.
So we proceed to the next. On 1st April, Rono signed a lease for a premise which required that he pays 120 in rent per year. Rono paid a check, paid this by check through the business bank account. So we're introducing cash rent account. I open a rent account. So Rono on that first, we debit rent. So say on 1st of 4 of 18, it's through the bank. We say bank. That is 120. Then on the bank, this account that was put in the bank, we credit again for 18. Call it rent 120. Tumeelewana. Rent is 120. Watu wangu tuko sawa?
Yes.
Perfect. I can wrap this at the end for other entries. So we told entry 3, during the year the premise was repainted. The premise was repainted at a cost of 7,500, which was paid by cash from Rono's private account. Which was paid in cash from Rono's private account. How do you deal with that? Repainting. So you can call it repainting. How much? That's an expense. That's an expense. For the painting, that's 7,500. So we have one that was on the date during the year. During the year, we're not told date. We can just have it in order to capital. It basically came from capital. Capital, that's 7,500. So on the capital, we have repaint. We just call it repainting. Repainting. That's 7,500. Together. Two copper module. Is that understood? Are we together? The 7,000 was basically from his own pocket. That's why we put it as capital. The unit of the paint was bought. The paint was bought. The paint was bought by Rona, shillings 35, and was paid by check through the business bank account. The paint was bought. So how did you do that on the paint? Number one, we know that the paint we know that was paid paint. We have paint. The figure is
We can't see where you're
35,000.
writing.
Yes.
You can't see where you're writing on the far on your right.
You can't see it. Let me see if
Yes,
I can.
where
You're saying?
I'm saying where you are writing paint, we couldn't see.
Can you see this?
No.
Let me see whether I can adjust that camera. Let me see whether I can adjust that camera. Are you able to see it?
No.
See?
You can only it's only visible up to capital account and cash account. Otherwise, no.
You still can see the corner?
No, just use the space under repainting.
Adjust?
Just use the space under repainting.
I'm not getting you. Are you able to see the bank account at the fine? Are you able to see the bank account?
No.
Are you able to see it?
Unless it's just me. Other people are not answering, so maybe it's just me. So
No, it's
I'm
not
asking
visible.
a question. I just want you to respond. Are you able to see a ledger of the bank account? Are you able to see that? Are you able to see that? The ledger for the bank account?
No.
You're not able to see it. So that should be the first thing. We see how we can get that ledger for the bank account. We need to see how we can get that ledger for the bank account. That ledger for the bank account. That ledger for the bank account. I don't know why. I don't know why. Yes. Can I do the bank? What about equipment? Are you able to see the equipment?
No, only four ledgers are visible.
You're not able to see the equipment. Should I write them here? Let me just copy them again on this other end. So I can have bank. Put our almost ledgers now. I hope we okay. So I don't need to keep them here because you cannot see them. Tuko sawa?
Yes.
Perfect if we are together. So on that bank account, we say on that bank account, what happens to that bank account? There's a pen, there's a paint together. There is a paint. So we know that there's a paint. How much was the paint? How much was the paint? How much is the paint?
$35,000.
35,000. So the bank account would credit. We have it paid. What happens? So what is the next double entry when you have that?
Bank.
So that is the bank. We credit the bank. So what happens?
We debit paint account.
We debit. We can have a
Paint.
paint account. We debit with bank. We call it bank. That should be 35. Together. So the next we're being told. The next we're being told. In addition, we're told that in Ronald also bought furniture at a cost of 120, which was paid by check through the business bank account. So we open a furniture account, another account called furniture. So how much was it bought? It was bought through check. So we call it furniture. How much was it? 120? 120. Then furniture we also debit by bank. That should also be 110, 120. Tuko sawa? Are we together on that?
Yes, we're together.
Then we have the next. In addition, Ron also bought a safe, at 30,000, which also was paid through check. Ron also bought a safe. How do you deal with that safe? Ron also bought a safe. Ron also bought a safe.
We open a safe account and debit it and then credit bank with that equal
Yes.
amount.
We can open some may not safe account. Maybe safe is not a fixed asset. We will not, we will get to know. So then we have safe 30. How much was it? 30. Was it 30, the safe account? How much was the safe account?
Yes, 30.
30. Then we can open the safe account and you say bank. We have it as bank. That should be 30. Together. Can we proceed until 11 today? Ama you're a bit tired? Tunaweza enda mpaka 11 tumalize hizi ledgers, or can you finish for me these ledgers so that tomorrow we just do the question? Can you finish the ledgers?
Yes, we can finish.
Yes, we can try.
You can do that for me so that tomorrow when I come, I find kila mtu amefanya ledgers, so mine is just to correct. Can that be perfect? I'm seeing many people are leaving. It means that guys are getting tired. We were 13, I'm seeing 7. So can you promise me, Jane, that tomorrow when I come to this question ni kuifunga, tunamaliza na hizi, alafu tunaifunga. Is that okay?
Yes, that's okay.
Yes.
That's
Yes.
okay. So do that for me. The ledgers, do that for me. I love this question because there's a concept on ledgers that is teaching, but at the same time, you get the ledgers is when you go to the statement of income statement and the statement of financial position. So that is your assignment. Do the ledgers. When we meet tomorrow, we summarize on those ledgers, then we close it. Is that okay? That should be perfect. We close it.
Yes.
There, so you can leave. Thank you so much. I know guys are very strong. Wengine wamekaa mpaka saa hizi. Very nice. So tomorrow and Monday, you're meeting. Monday in the afternoon, let's say from 1. From 1 on Monday. So we can close it there. God bless you and have a good night. So nipigie picha hizi. Wengine wameenda. Kila neno wameenda. Wameenda sana hivi. Wapi? Ndani kwa group. Hapo sio kwa group ni hapo. Yaani kuna neno wameenda tu hivi. Walienda na Jobash. Jobash alikuwa. Jana alienda kwa nani? Peke yake. Alikwambia ni baba bado. Alikwambia ni nilikuwa najua hapa. Bado kuna nini mbaya? Hata nilikuwa nataka kuuliza kama utamake na hiyo bora. Singe mix. Na wewe ungepiga kelele. Kama utamake na hiyo bora. Hapana. Nini? Sasa sana. One more. I didn't know how it would come, but I knew I would come. Not to go out there. I knew I had to come. So much that we could have was a fun, yeah, that's